Alright, Joe, here we go. So, I got some notes, got some things to cover. We're going to cover a lot of things. Just need you to be aware of some of these things. You don't have to know them all. You see, I haven't made notes because I'm a nerd, because I'm a good uncle. So, you know options. Options give us leverage, So, if I wanted to take a Microsoft position, they're $300 and something a share. I ain't that kind of rich, but options give us leverage. And there's a few things you need to know. So, one, biggest mistake, get time on your options. So unless you're playing earnings or a news catalyst or something like that, a lot of people make the mistake of getting cheap short-term options, 1, 2, 3 weeks out. And the problem with that is theta decay or time decay. Because every day you hold an option contract, there's a set amount it's going to bleed off and lose money. So biggest thing, get time. Time, a lot of things can happen, So anyway, options give us leverage. I tell a lot of people, think of options contracts like coupons, basically. I'm paying $20 for this contract in the hopes that I can buy it at that same price a month from now, but the stock is up, a lot, so I can make profit. That's instant profit, right? So the other thing is, they give us leverage, like I said, so you can actually calculate this leverage. You can take the delta of the option contract divided by the contract price times the share price and see how much leverage you're actually getting. So basically you can calculate how many shares essentially of leverage you're getting with that option contract, and you'd be amazed. Sometimes you can get 50 shares of leverage for a cheap price. And again, there's a formula for that. Again, delta divided by the option price times the share price, and you can find the delta always by clicking on any option contract. So right here, you see your Greeks, your delta, your gamma, your theta. So for every day, this contract is going to lose 3 cents, right? Or $3. So it's 3 cents, 100 shares. So 3 times, you get it. Vega and Rho, we can talk more about the Greeks later, but the biggest ones you're going to deal with a lot are theta and delta. And again, you can use the delta divided by the contract price, or the option price, times the share price, and figure out how much leverage this contract gives you. And I actually own this contract, bought it for, I don't know, $30 or something, and it's in the money now, so that's good. And basically I was playing earnings and playing the pandemic. The more things open up, the less people are going to use the online services, and maybe not even, that's just a perception. I don't know, if they're actually going to use Petco less or whatever, but generally, when lockdowns happen, what happened? Airlines went down, cruise lines went down, Amazon went up, Zoom went up. So all these things, you can kind of see a separation. We'll talk more about catalysts and things to look for in the market to make plays. Because the other problem people do is they just, they find a stock they like and they're like, well, I think it'll go up in a month. Well, and that may be true, but with options, you really want implied volatility to increase, meaning you want more trading activity, more volume. And to do that, you generally need some kind of catalyst. You need a news event. You need earnings, which happens every quarter. You need, some kind of merger or, some weird world news that somehow affects that company. And again, we'll talk more about catalysts. But again, I put some notes here, some option catalysts are earnings. So every quarter, companies report their earnings. They always have guidance leading into it. They try and price it in on the options, but if a company beats earnings by a lot, that's going to help. That's going to shoot up implied volatility. People's going to be FOMOing into it. Same things if it goes down, So remember, with options, we get to short sell. We don't always have to just bet that it goes up. We can bet that it's going down, and that's good power. Because, sometimes company will have good earnings, people will start buying all the calls, but they overbuy and it starts to drop, anyway, things you'll learn as you go. Some of this just takes time and experience, right? Company partnerships, mergers, new products and services. So, every time an iPhone comes out, Apple goes up, and sometimes you'll see chip makers go up as a correlation, or what they call a sympathy play. So market reactions and sympathy plays. Say news breaks that DraftKings gets the green light nationwide to do sports betting, right? But say, by the time you heard the news, DraftKings already up 10%. You don't want to grab contracts that have a bunch of premium on there, because anytime day to day a stock's going up, those premiums on calls are going to be elevated. and vice versa, right? So look for similar companies or sympathy plays, right? So maybe DraftKings doing really good. Look something else in the gaming space, like a casino stock like Wynn, or some kind of sports bet. There's a lot of different stocks. Sometimes you may miss the main play, but you'll find sympathy plays, right? So, maybe Amazon's going on strike. Well, that might affect, the truck drivers. So you can look at trucking companies, and, there's a lot of correlations there. This works both ways. I put in the notes here, so if Amazon gets a big government contract, you can look at Target or Walmart. They may drop because they're not getting in on that action. So again, market correlations, and things like that. Look for correlations between the markets. Examples: when lockdowns hit, Zoom, Amazon, Walmart shot up. These companies are going to benefit due to lockdowns and things, right? That makes sense. But travel and airlines, cruise lines all went down. And so, we've seen a lot of reopening trades now. Cruise lines shot up a little bit when lockdowns were lifted and stuff, but then Omicron and Delta come, they took a bit of a hit and they went down, right? World events, you probably heard about China's Evergrande mess, and they're basically like a big real estate developing company in China. They took massive amounts of leverage. Lockdowns hit, all this stuff. Basically, they start having trouble paying their bills. Now, of course, their stock went to shit. But also other Chinese companies and real estate companies started feeling it. China's banks started feeling it. So it affected the entire Chinese market, right? And some of that affected the U.S. market. Rocket Mortgage, UWMC, all took a hit since Evergrande's been going on. So again, world events will affect these things. You just got to find the correlations, and don't be impatient. Not every day there's a good play, right? Or a good play you can find. Don't FOMO into shit. Don't force a play, and never be afraid to take profits like you did today. Hey, 100% profit, dude. If I told you yesterday, hey, you're going to make 100%, but you got to sell it, you'd of course take it. Some of my best lessons are some of my first options, them being up 100, 200%, and me thinking, shit, it's going to the moon, and holding it, and the next day it takes a shit, and I end up expiring worthless. And that really sucks. Never hurts to take profits. And I'm going to show you a couple tricks that will help you do that, right? Oil, energy, this is more market correlations. You've seen the oil prices go up and down. So you can look at sympathy plays. Maybe Exxon's up really good. Look at BP. Look at, Phillips 66. Look at other energy. Look at Marathon Oil. There's whole categories. So I use this as my long term, but you've got all kinds you can see. You can come through here and search through all these utilities on TD or almost any site and just find different, small stocks or stocks you're not thinking about. I use Robinhood mainly for options because it's easy to use. So I've got my Robinhood debit card. I'll, make some money. I'll cash it out and I'll put it in my long term somewhere. I have a few other accounts too, but basically that's what I do. So again, you can look at these contracts, and I bought this a month or so ago. I didn't get a lot of time on it, but it was relatively cheap. But you can see it's doing okay now. But it's in the money. I got to make a decision because we've only got 10 more days on this, and every day this is going, right, my theta is there, $3 a day, right, at least. And that can change too if implied volatility goes up. So right now implied volatility is at 52%. That's kind of high. If that shoots up to 100%, that's going to juice all the premiums, but it's usually short lasting, and you can also get nailed by something called IV crush. That happens a lot with your meme stocks and stuff. Prices are super elevated and they can fall fairly quickly. So we'll talk more about that later. You can watch some videos on it. Some other things to know: open interest. That's how many contracts people own at this strike. So 1,000 other people own this. And you can see all the rest of this, right? So you can actually add it to the watch list now. I need to try that. I haven't added anything to my options watch list. That just came out today. But anyway, so, always get time. Try to get close to the money. So that means don't buy, way out here expecting it to do anything, because not much is going to happen here. And do a couple things. Make sure you calculate how much leverage you're getting. And you can always go to Options Profit Calculator and kind of get an idea of, what you're looking at as far as profit and loss. And it kind of does that on Robinhood already. But I wanted to cover those things. Tips to avoid losses. Keep it small. Don't FOMO into a stock. There's always new opportunities. You're going to miss some. That happens. Have a plan going in. That's what I was telling you last night. So you got your Twitter position. It was doing good. How much money is enough? Always have a plan. Say, hey, if this hits 100%, and it starts to turn down, I'm out. Or I want 200% or something of that nature, right? Just, have a plan. A lot of people don't have a plan. They just open contracts and then they just, watch them go. And they probably miss opportunities. So take profit. Don't be greedy. If you make 50%, take it and find some new plays. There's nothing wrong with that. You just don't want to lose money. Sometimes you will. That's okay. The trick is to, get all the profit you can and redeploy them. The Ghetto Spread. I'm going to show you that in a minute because you could have done that today, and I'll show you why it's really cool. Don't buy random options because they're cheap and you think it'll move. Use catalyst, news, events to find plays. So again, Twitter may be a good play. What was your logic behind it? And you may have had some, but if you're just getting it just because you like the stock, that's another conversation to have. But for options, you're going to make the most when you hit these trigger events, right? So just be patient. Sometimes there's not great plays to make. Use the Ghetto Spread. So I'm going to show you what that is because you could have done that today. So the Ghetto Spread is basically, so I've bought this call option. It's doing good. It's in the money, right? And I kind of like the profit there. I've got 60, 70 bucks of profit. I had to pause there for a minute. They're doing construction. I only got a few minutes left too. So right now I'm at $93, right? And I could use that money. So now instead of selling this, what I can do is say, hey, I want to keep a little position open, but I want to take profit too. So what I can do is I can sell the one right above it. Damn it. So again, the Ghetto Spread. I own this one. I can sell this one and get $68 in credit, right? Total credit $68. I can turn that into a Ghetto Spread, and then I get that $68 immediately into my account. I leave this open, and I can still make the difference here, which is just 50 bucks. But that allows me to take my initial profit and get my money back with some profit. It allows me to keep a position open, and that's it. I don't have to do nothing else. So that's the Ghetto Spread, and you can do that. If I wanted, I could just sell the 48, and I could leave myself another 100 to make. Because you'll make the difference here if it continues to stay up, right? But that's the Ghetto Spread. So I own this. I can sell any of these and take the profit and leave a position open. It basically turns it into just a debit spread, but we call it the Ghetto Spread. And that's a way to take profit, secure your money, and leave a position open, potential to make more. So that's the Ghetto Spread. It's a really good technique. And again, the other thing I've told you, sometimes if it's cheap, I'll buy 2 of the same option or 3, and that way if it hits 100%, I can sell one, then I'm free riding, got my money back, got some profit, I'm free riding the rest. And if you own, 3, 4, 5, you can sell a couple, make your position free and ride it out. So that's a good strategy. A lot of people don't do it, but anytime you can make something free, take some profit, I do it, right? So that's some things to know. Again, learn this formula. Figure out your leverage. Use your catalysts, right? Use your catalysts, especially earnings. I'm always checking earnings. This Wolf was an earnings play. Intel, I don't remember what that was about. But anyway, that's playing earnings. It's doing all right. So just use those kind of catalysts. You can always check earnings on Robinhood. Somewhere they have an earnings thing. You can look for it. You'll find it. But that's some things to know. This is my long term. You can see all the stuff I've got in here. This is one of them. I've got this account. I've got Durana's account. This is the one I started building 6 months ago or so, and I just buy in shares slowly. Get a lot of divvies. These ones with these weird numbers at the ends, that's free shares I'm getting, or free dividends. I'm just automatically reinvesting it. Because eventually, a couple of years from now, we'll get that compounding interest, right? So I've got some option plays open on here. It's doing all right. Apple, Oracle, Palantir kind of fucked me, but I really like the stock. This is old, but it fucked me. But so I do options on this. I prefer Robinhood I prefer the interface on Robinhood, I should say. So lots to go over though, and this is just kind of a primer. Again, I can send you this if you want. It's just notes I made for you. Again, it's just keeping it simple It's not super complicated, but it is. I know it kind of is, but at the basic core of it, you just want catalysts. You want news events. You want